G'day Internet, Max Wright here, and I'm supercharged this morning because I get to talk to Dr. Jeff Ross, and I'm pumped because we're kind of doing this thing every month. I hope that gets to continue, but I know your time is becoming very, very valuable because you're blowing up online. You're all over the place. Your Vailshire is just growing like a weed in a good way. Bad analogy. Early in the morning for me, and yeah, I love talking macro with you. So let's get into it. We're 2 days after so just so everyone knows, this is Friday, February 23rd. We are 2 days after the last FOMC meeting. We had a 75 point bips increase, and actually the markets were a little boring. I thought there would be a little bit more action. What's your take? What's happening here?
Yeah, well, first of all, thanks for having me back, Max. I always love talking to you as well. So yeah, I mean, I think things are starting to heat up, and I think we're starting to see a little bit of that today. What made the news so far this morning is people are watching the CDS rates on Credit Suisse, the bank. They're watching it, or they're watching CDS rise in general on banks around the world, and Credit Suisse is raising cash right now.
So hang on, let's slow that down. What's CDS? What's that mean?
Sure. So a CDS is something called a credit default swap. The way to think about what a CDS is, it's kind of like insurance on a bond. And so if you think that bonds are going to have trouble and that a company, basically the underlying company or country even, is going to have trouble paying back its debt in real money, that you buy CDS, you buy insurance for it. So when CDS rates rise, that means people are getting scared that that entity is not going to be able to pay its holders back, the bond holders back. So Credit Suisse, we've been watching those CDS rates rise for some time. Today, the announcement came out that they're raising cash. So what does that all mean, kind of in layman's term? It means that commercial banks, big, powerful, well-capitalized, we think commercial banks are going into self-preservation mode. That is a serious deal. And so this is what happens when you get into recessions and into the throes of a bear market. Basically, what's going on is during good times, it's commercial banks that create the monetary supply. They expand the monetary supply. How? It's by they make loans out, right, to individuals and to businesses. When they make loans out, that's what expands the monetary supply. When liquidity is expanding throughout the world, risk assets do very well. We had that expansion going all the way up through basically the fourth quarter of 2021, and then we peaked, and then we've been on the decline since then. And now that trend is starting to accelerate. So what trend? Monetary contraction. So banks, instead of lending money out to individuals and to businesses, instead of doing that, they're nervous about the economy. So they're contracting, they're raising cash, they're increasing their own liquidity, they're selling their assets to increase the amount of US dollars that they have. So less loans means less monetary supply, means that's bad for risk assets. So that's why we're seeing these drops in the S&P 500 and the NASDAQ even more. Bitcoin, crypto, all these things that are considered risk assets, even though that both of us don't think of Bitcoin as a true risk asset, but the markets still do. So it still gets lumped in there like it's a little tech stock or like it's another crypto. So these are tough times for risk assets, and so people who are long only in those types of assets, they're kind of getting their face melted off at the moment. And I think it could get worse. This is when you see big banks like Credit Suisse having issues. I mean, this is kind of reminiscent of 2007, 2008, the Lehman Brothers moment. We may be at another one of those Minsky moments where we have another kind of Lehman type event where a huge institution starts to really have trouble. And when that happens, similar to what happened in crypto not too long ago with Terra Luna, when a major player breaks, the contagion effect can be very serious, and it happens really quickly, and the floor can drop out. And so that's kind of what I'm watching right now. That's what a lot of guys in the bond markets are watching very closely. What happens to Credit Suisse? Does the Fed come in? Do we see more bailouts? Which banks really are as solvent as we think they are, and if banks are having issues, the other thing to consider, by the way, is that countries are having issues. So European countries are having trouble with these rising rates. Highly indebted countries like Italy, like Greece, like Portugal, like Spain, the pigs, we call them for short, they are having a lot of trouble right now. And the higher rates rise, the harder it is for them to roll over their debt and to keep trying to pay it off. And then on top top of everything, we're heading into a major recession. And on top of that, there's the war in Russia and Ukraine, and energy prices are off the charts for Europeans right now. And so that's a huge issue. So anyways, everywhere I look, I see fires here, fires there, and they're starting to get bigger and hotter. Again, we're coming up to that moment where it kind of is starting to feel like the floor might be starting to drop out. So just buckle up.
Yeah, and let's also throw in there the Chinese real estate market,
Yep.
another huge flashpoint. There's just so many potential black swans everywhere you look. And so, okay, so that leads us. Later on, I'm going to take a contrarian opinion, but right now I'm going to agree with you because I do. So what's the best way to actually? First of all, let's cover a few things that are going to get hurt, like ARK Invest already down, 70%. I mean, it can get crushed in a scenario like this. By the way, for everyone watching, there are inverse ARK ETFs you can follow to profit off of that. So one way to profit from this. But what are some of the big dangers? So you talked about risk assets. What are some of the big things that people are going to avoid? And please also include bonds in this, as in treasury bonds, because there's a big divide there. Like I think most people are saying bonds are in a world of hurt. And then you got these Harry Dents who are like, no, it's going to go up. So what are your thoughts on bonds? And then what are your thoughts on the biggest danger things that you need to avoid right now?
So historically, when we're heading into a recession, and by historically, I mean at least over the past 40 years during the big bond bull market, one of the places you hide during a recession and a bear market in risk assets is in US Treasuries. So that's what most people think of. What do? You go to cash, you go to bonds, you go to gold. Now, what's funny though is this time around, we're not in a typical recession, at least typical for the past 40 years. We're in an inflationary recession. And when you have high inflation and a recession kind of going on at the same time, bonds don't work as a safe haven asset that they have in the past. So a lot of smart people, and I won't name names, people who say things like buy bonds, wear diamonds, I'm not going to say, they've been very long into bonds thinking that this is kind of the trade of the decade going on right now. And they've been getting their faces ripped off because of it. The bond yields keep going higher, which means bonds prices keep going lower, which means if you're long bonds, you're getting wrecked right now. And it's supposed to be a safe haven asset, but it's not. And that's because inflation continues to remain sticky high. When inflation is sticky high, bonds usually track two things. So long-term bonds, 10-year, 20-year, 30-year US Treasuries, they track two things. They track the future growth of an economy and they track inflation. And what's so interesting right now is people are very subdued about the prospect of future growth. So the growth prospects, GDP prospects for the United States are very low right now, but inflation is high. And so you have these opposing metrics right now, and bond yields are right in between those two, trying to figure out what to do. And so I keep telling people I would just avoid it for sure until we see inflation truly break. What could break inflation? First of all, I would say inflation will remain high, kind of sticky high, slightly disinflating, and that's what we've been seeing. I think we're still going to see that until the floor drops out. When the floor drops out of these risk assets, what that does is it's a massive deflationary event. And so you can actually see, we might see inflation go from 8% to it might drop down to 2, 1, 0, even go negative before this is over. That's exactly actually what happened in 2008 and 2009. We had deflation, which is really unusual to have negative year-over-year inflation. So be looking for that. People are kind of talking about that like it's a positive thing because that will cause the Fed to pivot, to pause, and then to pivot and to get, start quantitative easing again. But what that means in the meantime is that literally everybody lost their shirts. Like that means the real estate markets crashed. That means stocks have crashed. I think that the NASDAQ and S&P 500 are going to go down 50% or more from their all-time highs. So, the NASDAQ hit around 16,000 back in the Q4 of 2021. I think it's going below 8,000. Right now, it just dropped below 11,000. It's now 10,850. Before this is over, I would not be surprised to see the NASDAQ below 8,000. I think we're not even close to a bottom yet. And if it happens quickly, it's going to feel like the world is ending. If it happens slowly, that's more painful. I don't want it to go slow. I just want to get it over with. I've said this before. I'm a tear the Band-Aid off kind of guy. Like just get it over with. So I kind of hope it happens quickly. But if it does, it's going to be just exceedingly painful in the short term.
So I know, like when the Fed first started talking hawkish, they first started saying, okay, we got the transitory inflation narrative wrong. Inflation's an actual problem. We're going to have to deal with it. I know a lot of people were saying that they might be able to get to like 4% cash rate, and then they're going to have to pivot. But I feel like, and certainly the words are that they're going to accelerate through that. Do you think they're going to accelerate through that? They're just going to keep going until they break something? Is that basic? I mean, that's kind of what they're telling us, right? We're just going to keep going until something's broken. And then what are their sacred cows that cannot be broken? It's like, oh, that's going to break. Okay, we have to pivot. Like, what are they going to let go? And what are the sacred cows?
If basically the bond market completely seizes up, and when that seizes up, because of these Lehman Brother type moments. So if big banks start to basically collapse and to be at imminent risk of bankruptcy, that means that they can't get enough collateral, they can't access enough liquidity. Like Credit Suisse has a lot of assets on its balance sheet, but the problem is the market's like, I don't want most of your assets. I only want this specific asset. I want US dollars, and I want short-term treasuries. Maybe I want some short-term Japanese bonds or something like that. They can also be nice for liquidity. I don't want all that other stuff you have. And so I don't even consider it real collateral. And when that happens, that's the kind of stuff that causes these massive seizures of assets, these freezes. Basically, we get no bid, meaning no buyers across major bond markets. And these are like trillions of dollar kind of amounts that we're talking about, billions and trillions. And when that happens, that's where the Fed is forced to act. They're like, okay, things are starting to truly break. They don't care about the stock market. They actually want real estate to come down even more. They want stocks to come down even more, and they'll get what they want there. But the real issue is when the bond market starts to seize, they have to act at that point, and that's really what they're watching. And that's when they're going to, and they'll get what they want too, because what's going to happen? Unemployment's that's a lagging indicator. That's going to start rising rapidly here, I think, in the next couple of months. And then and on top of that, inflation, which is a huge problem for them right now, that will quickly come down. It's all going to happen kind of at once. Like risk happens slowly at first and then all at once. We're going to see that. And then suddenly it's going to go from like things are maybe okay, maybe we'll get a softish landing, maybe this recession won't be that bad. I hear tons of people still talking like that. And then suddenly it's going to be like wham, the floor drops out, panic, the Fed's going to move in, Congress is going to be talking about it, the president's going to be talking about it, and then that's when we're going to see a pivot at that point. By the way, that doesn't mean that pivot, it does not mean that risk assets instantly bottom and rebound quickly. We may have some garbage to work through for a while until markets actually find a bottom.
Okay, so even post pivot, you don't think that's the bottom?
Probably not.
Okay, very interesting.
Yeah. And historically, I'll just throw this one out. The last time we had a kind of similar situation is the global financial crisis, so 2006 to 2009. Interestingly, the Fed was hiking into that, and they stopped hiking in 2006. So if you remember back at that time, the markets still went up for a while after that. They flatlined, they paused, markets kept going up, and then there started to be cracks in the system. Things started happening, and then 2007, 2008, Lehman Brothers, started to have major problems. And then in kind of mid to late, I can't remember the exact time frame, but mid to late 2008, the Fed actually started doing quantitative easing, lowering interest rates. And the market still collapsed. So they absolutely collapsed fourth quarter of 2008 into the first quarter of 2009. The bottom was in March 2009. That was while the Fed was easing. At that time, they were lowering rates, but the markets didn't care. They had caused so much damage leading up to that, and it has kind of a delayed effect that all of that garbage had to get worked through. So why do I bring that up? Because I think something like that is going to happen this time as well. I think even though the Fed pivots, and then they even start lowering interest rates again and doing quantitative easing, I think it will take a while for the markets to bottom and for all of this garbage to get worked out, and then we'll find a bottom, and then it will be time to get back in again.
Okay, so this sounds like looking forward to the buying opportunity of a lifetime. How does one preserve capital between now and then in the safest way possible? And just I'll give you a little asterisk in there. Relate this to third-party risk.
Sure. So the easiest way for most people, so if you have a so first of all, this is not individual investment advice, right? These are just general thoughts. the easiest way for most people, the simplest way, is just to raise cash. Just if you have a 401k, IRA, brokerage account, whatever, and you're still like 100% in stocks and bonds, most people for the last decade were in some kind of like 60-40 or 80-20 stock bond portfolio with low fee index funds like Vanguard funds. That was great for last decade. That I do not think that will work well. And you've been finding that out. Clearly, it's not working well this decade, and that's going to continue. If that's you, consider raising cash. It's still not too late to increase your cash position. What does that mean? If you have 100% in stocks and bonds right now, maybe lower that to 80% and have 20% cash. Maybe lower that to 50% and go to 50% cash. Maybe get rid of all of that, sell it, and just go to 100% cash. Those are ways to do that easily. Why? Because cash is king during a recession. So yes, you do not want to own cash over the long run. Your purchasing power will get eroded very quickly, but you don't have to worry about third parties. You don't have to deal with any kind of that garbage. Cash, when people are scrambling for liquidity, and Credit Suisse is going to possibly have a Lehman Brothers type moment, everyone is scrambling for cash. Everyone is selling their collateral and clamoring for dollars. So the strength of the dollar rises, the Dixie rises relative to all other currency, and it's literally the best safe haven to be. That's for most people. So if you're a little more sophisticated to that and you have different kind of investment privileges that you're willing to do, actually the best way to actually increase your purchasing power during this time is to short risk assets. So that's what we're doing here at Vailshire. We're very short the NASDAQ right now. And some other things that I won't mention, but we have a higher than normal cash position. We're shorting risk assets, and we're just going to continue to do that as long as the momentum is in our favor. So if that's your kind of thing, if you're into that, just make sure you got to watch those kind of things closely, because they can go against you. The other thing to consider is bear market rallies are no joke. We had a serious bear market rally from the mid-June to mid-August. That really, like, again, I keep using this term, that's like a melt your face off kind of moment. It feels really bad if you're shorting the markets and the market works against you, because bear market rallies happen really quickly and they can go up quite a lot. So just be prepared mentally for that. So anyways, that's enough of the strategy things, but you got to take cover here. And a lot of things that have worked in the past aren't really working very well currently, like U.S. Treasuries.
Right. I want to come back to some of these comments, but before that, I want to ask an interesting question. Take the conversation to a different place. On a scale of 1 to 10, how would you identify yourself in the world of conspiracy theories and market manipulation, evil people behind the thing strategizing to take as much money off as much people as possible?
I have never been very good at embracing conspiracy theories, so I would put myself low on that. I do think people are greedy and people take advantage of situations, but as far as market manipulators specifically go, I'm pretty low on that scale.
Okay, fair enough. Thank you for that little background. So now I want to go back to what you were saying. You talked about cash position. In 2008, the situation was solved with a bailout, and that is all the losses are put onto the taxpayers. 2013 in Cyprus, there were what's called bail-ins, which means all the depositors of banks, they just ate it. And like if you had your money sitting in cash, you woke up one day and your bank balance was chopped in half. In the years following, all of the Western world has put it on the books that bail-ins are a potential avenue for them to use. It was not on the books in 2008. It is on the books now. How do you factor in managing that concept of is there a potential for bail-ins in the first world? Is there a potential for bail-ins in America? What risk probability do you give that?
That is a legitimate concern. And we think in America, like, that can't possibly happen to us. That could happen to us. When you watch major banks like Credit Suisse, like Lehman Brothers way back in the day, that different kind of bank, investment bank. But when you see commercial banks having issues, you start to wonder about the safety of your own cash, right? If you have cash in the bank, but that bank suddenly becomes insolvent very quickly, is that really your cash in the bank, or is that the bank's cash? Who owns that? We have FDIC insurance, so up to $250,000 per bank. Will that hold? It should. I mean, it would be devastating if that happened here, but that would mean we're in like serious, calamitous times right now. We're in a literal crisis mode. If banks are talking about basically foregoing FDIC insurance and be like, you know what, this is a special case. Sorry, people, but we're taking your deposits because, we need to keep these banks solvent. It's a systemic risk, blah, blah, blah. It's possible. How likely is that to happen here in the US? Not super likely right now, even with how bearish I am. I would still only give it maybe like a 10% chance, but that's still pretty high. A 10% chance that the bank can seize your cash and forego the vaunted FDIC insurance. Something to consider. And if you have a lot more money than that, I would be very careful. Like, say you have $1 million in a bank account, 250,000 may be covered by your FDIC insurance. They may say, okay, you can have that, but we're taking the 750. Thanks for your contribution.
Yeah, I'm sure you're aware of this, but for people at home, that $250,000, there was a similar level in Europe and in Cyprus, and they didn't take that. So everything above that, they took 50% of all the depositors' money. So the way I would love to come up with a way to store my cash in a boring way, where without that risk, without that counterparty risk. If you have anything thoughts on that, let me know about a way to do that. I got a few ideas, but so I'll just ask the question: do you have any thoughts on that? How one could store cash and reduce that counterparty risk issue?
Sure. I mean, I think if the most a conservative way and a traditional way to do it is buy gold. Just buy gold and store it in your house or somewhere safe. Bitcoin, you could buy Bitcoin and put that in cold storage. Bitcoin, though, as we talked about, is still really volatile. It's still acting like a risk asset. So you may have to deal with serious volatility. You probably will deal with serious volatility. Another way is you could put it in short-term treasury bills, like 3-month bills, or up to a year or something like that. They're paying nice yields right now. If you do a short term enough, then inflation won't eat away at it quite as much. That should be a safe option as well. So those are just off the top of my head. I don't know if you have other ones. I'd love to hear them.
Yeah, no, there are some creative ones there. Like it's the gold and Bitcoin thing. That's the problem is you're exposed to the gold and Bitcoin price. I'm like, and I agree with you. I think they're going down. So I do have some things, but not at scale. That's kind of the hard part. I can do it in little bits and pieces. There's a place. One of the places we recommend at the Success Council is a place where you can you're lending money, you're lending cash. So you're lending the money, so you're owed the money. But in order to borrow the money, they have to put up 2x the value in gold or silver. So they're using 2x gold and silver as collateral. If it goes down by 50%, you're still covered, and you can liquidate them and get your cash back and figure out what to do. So you got at least 50% protection there. So that's one of the mechanisms. Lending to people with really, really strong collateral is one particular market. And then I think the other one is so the tax sales, the real estate tax sales. Now doing this at scale and enough volume is a little bit of a challenge. But if there's a house there that's they've forgotten to pay their taxes, you can come in and pay their land taxes. I'm talking about right here in the US. You can come in, pay their land taxes. They've got this huge property. You're even more protected than the banks at that stage. And so as long as that, there's a $200,000 house and you're paying $10,000 worth of taxes, you got a lot of protection there. If that goes down, you just pick up the house for $100,000 for free. So those are the two kind of strategies I see. Doing those well and effectively and at scale is a little bit of a challenge, but those are two of the methods that I kind of have. So okay, this third party risk concept. Now the other kind of thing is, it would be great to just not be exposed to that risk at all. But I think the minute that anywhere in the first world, bank depositors have their accounts chopped in half, the price of gold, Bitcoin just absolutely explode. So a little bit of a balanced portfolio is going to be your protection there. I mean, I could see if let's say Chase or Wells Fargo have all their bank depositors, all of them are losing money, even if there's a bank holiday for 3 weeks. I mean, watch the price of Bitcoin and gold. It's going to go parabolic. Right. So hedging it is cool, but it'd be nice to hedge it without even having the risk of losing the cash as well. All right, let's jump to dollar wrecking ball. Touched 112 yesterday. I think the day before. Now down to 111. But like you kind of touched on it before, it is the safe haven. It's where people are going to go if things get worse, and we both believe they will. If things get worse, people are going to be running to the dollar, and that's just going to explode in value. But what does that do to the rest of the world? It absolutely destroys them. Becomes a vicious cycle. You now come into the situation where at some point, are they going to be forced to leave the dollar? So I hinted at it earlier. Let me play contrarian here for a second. All the markets are crashing. People are rushing into dollars. dollar's going to explode in value for that reason. Okay, with you there, everything makes sense there. Some things that might be different this time. Famous last words, right? Some things that might be different this time. We have a situation now where we have a petrodollar system. Saudi Arabia, you know all the history there, right? We got Saudi Arabia signing military deals with Russia, with China. We have the US abusing their power, confiscating Russian money, et cetera, et cetera. The world is looking for a solution. The whole world is looking for the solution. Like, this rising dollar is hurting everybody. The people, the Russias and the Chinas of the world who are a little more anti-American, let's say, they're building systems and parallel SWIFT systems. Could the day come where everyone's rushed to dollars and the Saudi Arabia comes out and says, we're no longer doing the US dollar, oil priced in US dollars, we're now doing it priced in yuan or ruble or some basket thereof? What would that mean overnight? How far away are we from that moment, if that moment is at all? How does that figure into your risk profile?
Well, I think that's already happening. I think it's clearly, happening. There's the block of countries, China, Russia, India is getting into it a little bit. The Middle Eastern countries are getting into it, some African nations. They're trying to create an alternative to the US dollar as the world's reserve currency system, because if you're a part of it, you're kind of slave to it too. And that means that the US sort of can control your destiny a little bit. A lot of these countries have been sick of it for a long time, and they've been doing something about it. I would argue that China's been doing something about it for at least like a decade or so. They're trying to create this alternative path where the yuan is an actual reserve currency as well. And so I think it's happening. It takes a long time though, right? Because you got to build all the infrastructure out. It's kind of like what we're seeing with Bitcoin. It takes a long time. You have to build the infrastructure out until it becomes, the more ubiquitous it is, the more useful it is, and the more practical it becomes. This is the same thing with the Chinese yuan. So it's all happening right now. The dollar is, I totally agree with you. It's crushing countries right now to have this strong dollar, especially if you're a developing nation and you have debt and US denominated debt that you have to pay back. The value of your currency is just dropping precipitously against the skyrocketing dollar. You have to still pay back that dollar denominated debt in your little wimpy currency. It's killing you. And then on top of it, you're headed into a recession also. So life is hard, and it's going to get harder for people. And it definitely kind of can spiral out of control for a time. I think at some point, this is going to lead to a moment where governing officials are actually concerned enough where they meet about it, and they're going to be talking about, what do we do about the strong dollar? Like, how do we get this down? Because this is crushing the world, basically. So that's coming up. I think we're going to see something about that within the next year or so as well. Again, coming back to, the Chinese yuan as an alternative world reserve currency, I think that's kind of inevitable. Maybe it's a basket of currencies, maybe it's the yuan itself. I actually think Bitcoin is a third player. That's sort of the dark horse in this race that's coming up, but it's moving quickly. As the infrastructure gets built out, that'll be another one, because it is pristine collateral as well, and because there's no, government intervention with Bitcoin that's permissionless. Interesting times, tumultuous times for sure, and there's going to be winners and there's going to be losers, and there are going to be a lot of unhappy people, and there's going to be uprising and geopolitical confrontations as well. Tough times. Like, I just continue to say, this is going to be a tough decade, and we haven't even hit the hard part yet. It's going to get worse before it gets better. So yeah, those are my general thoughts.
Yeah, I wanted staying on the topic of counterparty risk. So you're shorting markets right now. What have you done a deep dive? What are the counterpart? I don't have any money in the stock market, positive, long or short. I don't really know too much about it. Have you done a deep dive in what are the counterparty risks that you're exposed to? I've heard things like something along those, like 7 layers of custodians of bits and pieces along the way. What are the third-party risks in let's say like an inverse ETF? If that's I'm not going to go shorting things a little bit too complicated. Not down that path. But if I just want to put my money into an inverse ETF, what are my counterparty risks if that happens to be your area of knowledge?
It is. So it's not really, but I will say that in general, it is there, and that's the same stat I heard, is 7 layers basically of these counterparties that it goes through. So you're not owning shares of this business outright. It's not like a transaction between me and Starbucks if I own shares of Starbucks. There's all of these additional counterparties. Now, the system has been honed and refined, and the SEC has been regulating it for nearly 100 years now. And so they make they do their best to make sure it remains extremely liquid and highly functional, and these risks are mitigated throughout. The downside is, and this happened to some people back in 2008, 2009, people were shorting the market. And then at some point, the brokerage just said, you know what, these short sales are no longer allowed, and we're liquidating your position, and sorry. And so people who totally nailed it were just like, what do you mean? You know, like this is the play of the century right now, and you're telling me I can't do it? And they're like, well, yeah. And so those are the kind of risks. It's kind of like, you know, it's kind of like the bank moments when they're like, yeah, we're going to take half of your deposit. Sorry. So, and there's nothing you can do about it. And so that's definitely a possibility if things get bad enough. You know, I might be killing it in Vailshire, shorting my stocks and doing all this stuff, and then I might just wake up one day to have my brokerage firm just be like, yeah, we liquidated you overnight. You're sitting in cash now because you can't short stuff anymore because it's too harmful. You know, it's too hard on the environment right now, and blah blah blah. Who knows why they would do it? It'd be some dumb reason and some invalid reason. But it's all about self-preservation. That's the thing to remember for the government and for institutions. When they go into self-preservation mode, they don't care about you. They don't care about you, the citizen. They don't care about you, the customer. They want to survive. And so if that means screwing the citizen or screwing the customer, they're going to do it. And we've seen that happens all throughout history. And it's almost unbelievable to imagine during the good times, but during the bad times, that's the kind of stuff that happens.
I try to remind people, I say desperate governments do desperate things.
Yep.
And yeah, 100% they don't care about you. It's about self-preservation for them, which is ridiculous. They're supposed to work for us.
Right.
It's like you go and take the sword, sunshine, and leave us to be is how it should be. But it's no, we'll take everything off of everyone. They will take everything off of everyone to keep their power, to keep their status, to make sure they don't miss a meal. But if the citizens starve, that's okay. Yeah, really interesting. Any other thoughts that you got anything else you want to speak about today?
I feel bad being so bearish, but I really truly do it to warn people to be cautious. Like, this is a time to be cautious. I've been saying this for months and months and months. Everybody's sick of me. They call me Dr. Bear on Twitter. I'm just trying to help people, like, please, please, please be smart right now. Like, don't trust the system that it's there to take care of you. That it's not, there are times to be very long stocks and to make money, but there are also times to be in self-preservation mode. When you see countries and companies, big banks and whatnot going into self-preservation mode, maybe you should too. Think about, so the points you bring up, Max, about third-party risk and how do you protect what's yours? I'm telling you, they're not going to protect what's yours for you if they go into crisis mode. So maybe you should start thinking yourself about, how do I protect what's mine and what I've worked hard for myself and for my family. So just be careful, be cautious.
Yeah, I'm not sure how sophisticated a strategy it is, but I'm just lots of Bitcoin, lots of cash. And if something happens in the world of cash, if banks getting bailed in, if like depositors are losing, if something or whatever, if Saudi Arabia comes out and announces whatever and the dollar crashes, that means Bitcoin is going to go do very, very well.
Mm-hmm.
I think more likely Bitcoin will do poorly and cash will do very well for a little while. But that's kind of my barbell. It's not bonds and stocks. It's Bitcoin and cash.
Yeah.
Is kind of the strategy that I'm kind of sticking with here. And just with an eager eye, develop the thing I tell people: develop your skill set, preserve as much capital as you can, because your skill set and the bargains you're going to see are just going to be absolutely phenomenal, and it's going to be life-changing wealth. If you have a little bit of money behind you and a skill set where you can take over businesses, I think they're going to be giving businesses away. This business is going to get crushed. There'll be like all these people who are like these, the boomers are going to retire. Their sons and daughters aren't really interested in that business, weren't interested in that business, don't want that business. The guys like the former business owners, like, I've got to retire, I'm near death. If someone could take over this business and just keep the employees employed, I'd be happy with that. I think we're going to be able to pick up businesses for free. That's how bad it's going to get, I think. So keep your skill set high, preserve whatever wealth you can. Come out of this with something, and you're going to be in the top, handful of percent, because most people are going to get wiped out. All right, Jeff, thank you so much. Yeah, we're like both doom and gloom over here, but there is light at the end of the tunnel. You know what? I want to ask one more question, because we talked about the light at the end of the tunnel. How far away is it? Like, I'll ask two questions here. How low, and I think Bitcoin is the most interesting one for our audience, how low can Bitcoin go, and how long do you think before it comes back to today's price?
That's a tough question. I don't like using price targets, just to be clear. Like I'm a big momentum guy. And so what I tell people is, first of all, during a recession, during a recessionary bear market, all bets are off. All the lines on your chart that you thought would hold, all the resistant, support lines, all those kind of things, none of that matters in a recessionary bear market. Like all bets are off. So could it go lower? Yes. Could it go substantially lower? Yes. I look at that as a very fantastic long-term buying opportunity, though, to be very clear. So at some point, we're going to bottom. All of these are cyclical. We're getting closer to the bottom of the sine wave where the business cycle is going to bottom, and then we do bottom, and then it starts to go back up again. We're getting closer and closer to that. So there is sunshine. There is a light at the end of this tunnel, but it's going to get worse before it gets better, I would say. So I don't really have a good price target. I just would say the momentum is still solidly bearish. So be careful, like especially if you're a short-term person. For traders, this is still a time to generally be thinking of shorting. For long-term investors and savers, this is a time to be thinking about buying, because these prices are actually pretty fantastic. That's, to your point, the recessions favor the prepared. So if you are preserving your cash, if you have a high cash position, as the world all falls apart, you can be one of the people standing there placing bids when everything is at fire sale prices, Bitcoin included, stocks included, real estate included, businesses included. So raise your cash positions in preparation for it. How fast will it happen? I don't know. It depends. And this is kind of, and I'm not trying to be cheeky here, but it depends how fast it happens. So if the floor drops out and it just, everything falls apart, and Credit Suisse, we have a Lehman Brothers type moment maybe with Credit Suisse or some other companies, and everything just crashes and burns, it could actually happen within a month. We might bottom in October. I don't know. If though inflation remains sticky high and markets continue to kind of hang in there, and the Fed just sort of remains hawkish and keeps sort of raising rates like they're doing, this could go on for another 3 months, 6 months, 9 months. It just depends. It just depends until something breaks. When it breaks, you'll know that we're getting very close to the bottom. So be looking for a capitulatory type event.
And when you see that capitulation, that's when you become a buyer. Will you become a buyer on that event?
The way that I do stuff at Vailshire is I don't try to time the bottoms, I confirm bottoms. So I would wait for the capitulation, a bottoming process, and then momentum would just then shift from bearish to bullish, and then that's when I'll buy. So once a bottom is confirmed, and I'm really vocal, just so you guys know, if you follow me on Twitter, I'll literally just tell you, like, I'm bullish again finally. In my handle I say Dr. Bear, I'll turn back to Dr. Bull, and everybody's going to be panicking, and they're going to think I'm crazy again, like they thought I was crazy 3 months ago for being bearish. They're going to think I'm crazy for being bullish, but I'll let people know when I think it's time to get back in again.
One of the thoughts that gives me solace during those times, to have the courage to go buy something that's this kind of, when the sentiment is so bad, is that I picture a cycle, and as it comes down, and let's say you get it wrong, but it goes down a little bit further, like to get back to where you were, like is not, now we're talking, like, let's say the whole, like from peak to peak might be, let's say it's a 4-year cycle for Bitcoin, peak to peak is 4-year cycle. But if you've already come down like 60-70%, and then like to get back, come down to wherever it goes and come back up, that time frame that you have to wait is significantly shorter. That might only be 6 or 12 months. And so on those big and often a big capitulation usually creates a short squeeze and a bear market rally. Even if it does come down again, I'm still going to, like, on a capitulation, I'm still going to take some profits. It might come up and roll over and go back down again, possibly, but I've still got that time to play that and watch those things. So that's the kind of concept that I kind of keep in my mind to give me that courage to do that. All right, Jeff, much appreciated. That was super awesome chat. I love that one. We went a little bit off-road there, but I really enjoyed that. So thank you so much. You've already mentioned your Twitter account, but please mention it one more time.
At Vailshire Cap. I'm on Twitter a lot, so feel free to find me there. And then if you want to learn about the way I do investments, I obviously do investment strategies very different from most financial planners and investment advisors through Vailshire. So you can actually just shoot me an email if you're interested in learning more, info@vailshire.com.
All right. Let me know in the comments below, what is your portfolio? How are you balancing things out to keep yourself sane during all of this? I can't wait to find out that. Smash the like button, smash the subscribe button, and I'll see you guys soon. Take care.